The S&P 500 has just reached all-time highs, with big tech primarily leading the charge. Companies such as Nvidia, Microsoft, and Google have continued to rally higher and higher, and stocks are generally looking pretty expensive as they currently stand. That being said, there are always stocks that are at good purchase points, and in this video, I'm going to go over 3 different stocks that are looking like good buys due to their healthy evaluation in an otherwise expensive market. So let us get right into it. Before we start this video, make sure to like and subscribe if you're new to the channel, because I will be posting dividend stock videos just like this one every few days. The first stock on this list is a stock that I own personally, and it is the Vici REIT, ticker VICI. Vici Properties Inc. is a real estate investment trust that owns and operates a diverse portfolio of gaming, hospitality, and entertainment destinations. They primarily focus on leasing their properties to leading gaming and hospitality operators. Basically, they lease to large casinos and other specialty businesses in the gambling and resort industry. Vici currently owns an impressive summary of assets, which amasses to 54 gaming facilities, 39 non-gaming experiential properties, and over 500 clubs and bars. Some notable ones are the Venetian, Caesars Palace, and the MGM Grand, which are all on the Las Vegas Strip. Some of their leases are extremely long-term as well, supplying them with consistent income for decades to come. In addition, the businesses they lend out to are generally good businesses that reap in tons of cash. I don't need to explain to any of you that gambling clearly generates a lot of money for casinos, and therefore, Vici doesn't need to worry all too much about a lack of payments coming from dying businesses. An older video that I recommend watching if you have the time is Joseph Carlson's interview with still current Vici CEO Edward Pitoniak. It is a good listen, and Pitoniak outlines some of Vici's core business models and differentiators that makes them a good REIT when compared to their competitors. He specifically mentions in this interview that their extremely long-term and stable leases are one of the main successes of this REIT when compared to others. While REITs with more casual locations, such as Realty Income, have to worry about a declining retail sector and other headwinds, Vici has a few core tenants with enormous streams of income. The stock also has some of the most fantastic growth of any REIT on the market. The stock is up 41.45% in just capital appreciation in the past 5 years. Factor in the dividend, and this stock has been extremely rewarding to long-term shareholders. The dividend also has great growth in itself, with a 5-year dividend CAGR of 10%, and their current increases are still very respectable, just sitting a bit lower than that. The stock, despite their growth, is still down about 15% since all-time highs, showing that this could be a good time to buy in. Any price under $30, and I will be buying some shares to add to my current position, as I'm also doing with Realty Income right now. Real estate is a volatile sector for sure, but is one that will continue to exist for decades and even probably more than that. I like Vici for their properties, and in addition to Realty Income, it makes for a great dividend stock, and that is why it is first on this list. The second stock on this list is Chevron, ticker CVX. The oil giant has had a great time since its COVID-19 lows of just under $70 a share. That being said, the stock has been beaten down recently, and it now sits at just around $145 a share. Like real estate, oil and energy is another volatile sector. The stock is now down around 22% from all-time highs, which shows that it could be a good buying opportunity for shareholders, as the stock now sits at far below market average PE of around 10.5. The stock has gone down for a few reasons that I will go over briefly. The first of which is that oil prices have dropped, with oil down around 20% from late summer last year. Overall, oil prices are still down nearly 40% from all-time highs. The second reason for the stock drop is Chevron acquired Hess Corporation, ticker HES, for an all-stock transaction valued at $53 billion. If you are familiar with anything about mergers and acquisitions, more often than not, stocks drop heavily on news that they are acquiring another company, and this was no different. Investors generally worry about acquisitions for a few main reasons, including overpaying. However, I think the Hess acquisition will actually play out nicely for Chevron in the long term. The Hess addition to Chevron's portfolio will add coverage to oil in Guyana and in the Bakken Shale in the United States. The Guyana coverage is interesting to me since it provides Chevron with high profit margin oil as well as low carbon intensity. This specific asset that came from the Hess merger should drive growth up in the following decades. Oil was discovered there within the last decade or so, and Hess has been one of the major players in the region along with ExxonMobil, Chevron's largest competitor. By taking the fight directly to Exxon, Chevron is getting access to more oil fields that should help prop up margins and revenue for the foreseeable future. Chevron stock also has a very nice dividend starting yield, sitting at just around 4.2%, which is pretty good. Dividend growth is fairly decent, with the 5-year CAGR sitting at just around 6%, which although isn't high in general, general is a lot higher than other energy stocks on the market currently. The dividend history is also fantastic, with 36 years of continued dividend payments and growth making them a dividend aristocrat. With a payout ratio of under 45%, Chevron can continue to grow their dividend and core business without letting it become unsustainable. Oil is volatile, and I do truly believe it will eventually slowly be phased out, at least to a certain extent. However, for the foreseeable future, this isn't going to happen. Especially now, with tensions in the Middle East growing, this stock does look like a buy, as it's at a fair value, and Middle East conflict could lead to supply chain issues pushing barrel prices higher, which Chevron would benefit from nicely. The third stock on this list is Automatic Data Processing, ticker ADP. This stock isn't necessarily as discounted as the other two stocks on this list, but the stock is still down around 12% from all-time highs. This, like Vici, is another stock that I personally own in my dividend portfolio. ADP specializes in managing payroll services for businesses. This includes calculating and processing employee salaries, taxes, and other related transactions. They basically manage the money that goes from the business to the employee. ADP also offers human resources solutions that encompasses various aspects such as benefits administration, talent management, workforce management, and compliance. ADP also typically operates on a subscription-based revenue model. This subscription fee is based on factors such as the number of employees. Speaking of which, one of ADP's biggest customers is Amazon, one of the biggest employers in all of the United States. This means that they do payroll for 1 in every 6 workers in the US, which is just insane to think about. Due to this, at any given moment, the company is holding anywhere from $20 billion to $25 billion of customer payroll funds before distributing them back to clients, which is roughly equal to around 25% of the company value. This, in theory, is basically a no-interest loan that ADP is able to benefit from. They say that they profit anywhere from 2 to 3% annually on these customer funds by investing it in extremely low-risk investments that can be liquidated at any given moment if that becomes necessary. Their abundance of cash has led to free cash flow for the company being a fantastic metric which they've used to reward shareholders. They are up 67.15% in the past 5 years, and they also pay an above-average dividend of 2.4%. The dividend has also grown at an average rate of 12% in the past 5 years, and the recent hikes are trending higher. This stock is a great stock that provides high growth but still helps balance a tech-heavy portfolio, making it a must-own for many investors today in my opinion. Some other notable picks that could have made it on this list but didn't are Starbucks, SCHD, Realty Income, and United Health Group. The reason I didn't include Starbucks is because some of their political drama. The reason I didn't pick SCHD is because it's an ETF and technically doesn't fit the list. The reason I didn't fit Realty Income is because I didn't want to have 2 REITs on this list, and the reason I didn't pick United Health Group is because of their below average yield. Thank you guys for watching this video. If you agree with my picks, let me know down below in the comment section. If not, let me know why as well down below. I haven't been uploading as much recently as I've been quite busy with semester finals, but I should be back and uploading soon. My plan is to make a consistent schedule of 2 or 3 uploads a week that you guys can rely on. Thank you guys for your continued support. It means the world to me. I will see you on the next video. Goodbye.